It sounds like you're rather bullish on the markets and what needs to go right, and that it's not near closing time, as the guest from Davos had said. I mean, 3,100 is your 12-month target on the S&P 500. That implies an 18% upside from the levels we're currently at. Does everything have to go right in order to get us there?
I do think the comment that was made about how we're close to dawn, I mean, we've almost come full cycle here. I would say by mid-year, Melissa, we're going to get off all the current talk, and we'll be talking about global synchronized recovery. We've come through a soft patch. And already had Draghi this morning talking about maybe cutting rates, Powell's off the table. I think that's a key driver. And once we get this trade deal done, that'll be stimulative to China. They're going to stimulate beyond that because their economy is clearly slowing. That'll be good for Europe. I think we're going to be looking at global synchronized recovery. The earnings season, to me, has been going stunningly well. The banks told us the recession's not happening, and now the tech stocks are showing us that the second derivative has turned. Things are getting a little bit less worse, and look at the reaction to these stocks. Everything is oversold. People are expecting a recession. That's not happening. And when you get pullbacks like this of 20%, like we had in non-recessionary periods, we've had 6 of these since 1960, you get pretty big bounce backs, somewhere in the order of 30%. Our 3,100 target, I know it sounds a little bit optimistic, but I think the consensus is going to move in that direction as we move through the next few months. Admittedly, the trade stuff is keeping people on the sidelines.
Right.
I think the market would be higher right now if it wasn't for that. But that's got to get resolved. Just a matter of when, not if.
There are two things, Amanda, that jumped out at me when Steve was talking just now. The notion, and it does seem like a minority maybe opinion, not a consensus opinion, that by mid-year we'll see a global synchronized recovery, because the data, at least the data that we got out of Germany and France this morning, don't seem to indicate that they're anywhere near a recovery at this point. And the notion also that a 20% correction implies a huge bounce back. That also implies that where we were before that 20% downdraft was a fair valuation for the markets. I don't know, maybe people don't necessarily think that we should have ever been there in the first place.
Well, there's no question we started 2018 at pretty lofty levels from a forward PE perspective. We got 5 multiple points of contraction over the course of the year. A little bit of uplift, obviously, on the earnings side from the tax package, but then certainly the market correction, contributed to it. I mean, our view is that we think by the end of the year we'll get to about half of that target, so call it high single-digit returns. And so with earnings growth projected at about 6% for the full year 2019, layer on top of that a dividend yield that gets you in the ballpark. The wild card is really valuations. And so, late innings of the cycle where we are today, hard to justify getting back to those lofty levels at the beginning of 2018. But at the same time, to the extent that some of these cross currents start to abate, we could see a little bit more upside from multiples.